bring in Michael Pond of Barclays Capital. His mantelpiece is breaking from all the awards they've won over there at Barclays. Good to have you here.
Thanks, Tom.
Is inflation back?
Well, inflation is not back now, but the Fed is basically saying don't count it out. You know, they will be looking to move inflation and inflation expectations higher in the coming quarters.
We had Abby Joseph Cohen on the other day celebrating 20 years with Goldman Sachs, and she came up with a word I'd never heard before, inflation. She said it's not dis, it's not in, it's just inflation. This conundrum between what you watch, which is future inflation, and the reality now of no inflation. Which do you focus on more?
Well, it's not no inflation right now. We're stuck basically in a low inflationary environment. We have trend growth of 2.5%. That's much better than negative growth or recession. But that means that the unemployment rate probably isn't going to come down sharply. And that means we're going to be stuck in this low inflationary environment, which means that longer term, the market's priced for us to never get out of this low inflationary environment. The Fed's saying that they don't want that.
Dreaded first chart, and it needs an immediate explain this. And now, ladies and gentlemen, the award-winning Michael Pond will explain five-year forwards.
This is something that the Fed focuses on. They want to see what the market expects for inflation longer term out. So if you take a 10-year rate and look at the second half of that 10-year rate, so 5-year inflation.
Okay, so you go out 5 years.
And then the next 5 years worth of inflation.
5 years out.
That's right. So what we've seen is that had fallen pretty sharply after the August 10th FOMC meeting. The market was priced for the Fed not to respond to a low growth environment. The Fed came out and changed their tune pretty significantly.
Here's the chart. You can see it, Michael, better on 2 and 3 because Vic is in the way there. You could see how we came down and we've really sprung back.
Exactly.
How sprung back are we? How much have we jumped up?
Well, we've basically gone back to a normal environment. On the low end of a normal environment to set that clearly. So if you take that chart back even further, we're at the lower end of where inflation expectations have been since 2003, when the Fed was once again uncomfortable with a low inflationary environment.
And you're linking here, of course, the bonds of the Fed. Rex, bring up the Samuelson op-ed, if you would, here. This is Robert Samuelson, Real Clear Markets, and, of course, writing off the Washington Post. Can the Fed fix the economy? Michael Pond, when you talk to Dean Mackey, are we asking too much of the Federal Reserve?
Well, the Fed is clearly saying that they want help from the fiscal side as well, but that even if they don't get that, they have plenty of tools in their arsenal to move inflation higher over time.
And I mean, the answers there. Robert Samuelson mentions there cures for the economy's lethargy. Barclays disagrees.
Well, we don't agree that, or we're not looking for very strong growth in the near term. Again, we have trend growth over the next year, a little bit above trend next year.
2.5%?
2.5% to 3% into year end, and then around 3% for next year. So we do expect the unemployment rate to trend down, but still be above 8 by the end of next year. That's not all that optimistic, Tom.
What's the number one thing that the gloom crew gets wrong?
Well, we do think that consumer spending won't dip. So we see consumer spending continue to trend around 2 to 2.5, which isn't great news off a very low base, but it's nowhere near a double dip scenario, Tom.
It's remarkable to see how original the discussion of last week was. And as we begin this week, what did you focus on over the weekend? What were you thinking about over the weekend?
Reading through Chairman Bernanke's testimony, what's very clear is that the mantra from the Fed has shifted from concern about deflation a month or so ago to now they're simply concerned with continued low inflation. This is something that Chairman Bernanke, or then Governor Bernanke, talked about in 2003, saying that the Fed needed to create a buffer zone above zero to not even get close to deflation. So they're uncomfortable not when it looks like we're going to be in a deflationary environment, but just when inflation is below their target. Their target is 2%. We're running around 1% to 1.5% inflation. They don't want that.
Michael Pond of Barclays Capital. Joining us from California, Anthony Crescenzi of Pacific Investment Management Company. Anthony, good morning to you. Let's get right to a chart here. And I want to bring up what's in the background, which is jobs. Bring me up chart 2, Rex, if you would. And this is Ed McKelvey at Goldman Sachs talking a long way from sustainable. This yellow line going across the bottom, folks, is one set of economists idea of where we need to be to get to some form of normal unemployment. Tony Crescenzi, we are a long, long, long way from a good unemployment rate, aren't we?
Yes, because many of the job losses are structural and not cyclical. It took 4 years after the last recession ended to get all the jobs back that were lost. Many more have been lost in this recession, so just by logic from that point alone, one would expect that it would take at least the 4 years it took the last time, and more because more of these job losses are structural, not cyclical. And the area I like to highlight in this regard is construction. That sector has lost 2 million jobs from the peak of 7.5 million. How can we imagine that sector rehiring the 2 million workers that were let go with the level of housing starts at a quarter of the peak? One can't, and so it's very difficult to envision how the job market snaps back in a meaningful way. And it's a big reason to expect a high unemployment rate for a long time.
Tony, you wrote your 1,200-page money market book there. Folks, if you need a doorstop, Mr. Crescenzi can apply that. Okay, so you wrote this doorstop of a book, and it's about bonds, it's about money market funds, and Michael, you follow this too. Tony, are we fooling ourselves? Is the Fed really focused on the unemployment rate at the expense of everything else?
Well, it's a means to an end. It is mentioning its mandate more and more. The word mandate shows up in the policy statements. It shows up in speeches. The Fed is paying attention to both. It believes that it could boost, by boosting inflation, it will boost the employment situation, but not by boosting inflation, but by doing things that could create more inflation, which is to boost, for example, nominal spending. And it hopes that through the inflation of asset prices, nominal spending will increase. And also, of course, through the low levels of interest rate or negative real interest rates, that this should boost spending and cause some inflation that, or I should say, boost spending in ways that help employment.
Okay, Econ 101, real GDP. And then there's inflation on top of it. That total space is nominal GDP. I've heard more about nominal GDP in the last 2 weeks than I have in the last 5 years. Michael Pond, it's remarkable how everybody's piling into the nominal GDP pool.
Absolutely. Well, Tom, we went through
it's like a throwback.
We went through almost a 30-year period.
It's as old as Bill Gross. Okay, go ahead.
We went through almost a 30-year period where lower inflation was always better from the Fed's perspective. They wanted strong growth, but they also always wanted lower inflation. That's just not the case anymore. We're at the point where the Fed right now would prefer higher inflation. And in fact, the level that they talk about that's consistent with their mandate, and let's just call it a target. It is what it is.
What is it?
It's around 2%, but very clearly they'd much rather have higher inflation than lower. So they say 2% is their target, but if you gave them a choice between 4% and 0, they'd always take 4 times.
That's the edge of Olivier Blanchard. Tony Crescenzi, help me out here. Olivier Blanchard of the IMF, a firestorm over his suggestion of reflating our way out of this mess. Does that hold credence with the new normal that PIMCO speaks up on?
Well, we expect that government involvement will stay high for a while, and this includes the actions of the Federal Reserve. It's not just a referee, it's a player in the market. It's affecting market prices, and investors have to be leery of the effect that the Fed has on market prices. And so this influence we would expect to continue for a while because, of course, once the Fed gets in, they have to get out, and that we don't know when that'll be. It could be a few years from now. But imagine a situation where the Federal Reserve hypothetically decides, we're buyers of 10-year notes at 2%, deciding to cap the rate. It would probably, of course, therefore absorb a lot of selling from foreign investors. And how does the Federal Reserve then restart a market like that? Not that this is a base case, but is one of the scenarios out there that Ben Bernanke has to consider when he suppresses the interest rate, because he's creating a dysfunctional market to some extent in bringing about these negative real interest rates.
I like that. Is it a dysfunctional market if we have QE2?
The Treasury market isn't dysfunctional yet, but that's actually why specifically they're avoiding the mortgage market. So last year they bought in the mortgage market, they bought in agencies, but they took out so much supply of those markets
that they messed up the market.
They're afraid that there won't be markets there anymore.
This is absolutely critical. Tony, is this going to happen in the sovereign space? If they take in 500 or 700 billion of full faith and credit sovereigns, does that mess up? Does that make the government market dysfunctional?
It's a small piece, but again, in a hypothetical example where the Fed decides to cap interest rates, one of the things that Ben Bernanke put in his menu of choices in November 2002 when he talked about things the Fed could do to combat deflation. Again, it's not high on the list. That's only in an extreme case that it would be likely.
Yeah.
But it does create some dysfunctionality to the extent that investors are being repressed through the low levels of interest rates. It's a negative real interest rate, and investors historically don't like negative real interest rates. And so you could say it's dysfunctional to that extent, but investors want the safety of treasuries. They want the safety of bonds. They want to be higher in the capital structure because they've had a couple of shocks in a decade, and this most recent one quite severe, and they want to have they care more about the return of the capital than on it.
30 seconds each, and I want to give Michael Pond the last word here. Tony Crescenzi, how far out the yield curve does the central bank control?
It depends on the way, first of all, the average maturity of the securities it purchases, and secondly, on its commitment on low rates. And this is what's evolving. We'll have to see on November 3rd whether the Fed tries to add efficacy to its efforts by creating what we would call an extended period.
Oh, I like that, Tony. Extended squared, very mathy.
Extended squared.
Extended squared. We give that to Anthony Crescenzi. How far? Rex is having a coronary in the control room. How far out the yield curve does the Fed control?
The Fed has an unlimited balance sheet, and they can use it however they want. So if they wanted to buy $1 trillion in 30-year debt, well, there's not enough debt that they could buy out there. But if that's what they wanted to do, they could peg the 30-year rate as well.
I want to give you the last word. What are you focused on? And all this cacophony, shock and awe, should they do it all at once or should they tranche in, Michael?
We think that's highly unlikely. The market may be priced for that, but we think it makes a lot more sense for the Fed to act in incremental purchases.
Like $100 billion?
$100 billion per month as a run rate, and then revisit that at every meeting. Again, the Fed doesn't announce, in normal times that they're going to lower the Fed funds rate by 300 basis points. They do a quarter at a time.
This is like a total geek fest. I'm loving this with Tony Crescenzi and Michael Pond. Mike, Tony, it's just simple with your authoritative book. The idea here of the debt that is out there, it's just remarkable the size of our national debt, isn't it?
It is, and that's a big question for investors today. The indebted nations include the developed nations particularly, and those that are moving up in the scale in terms of how their indebtedness looks. Debt to GDP ratios are improving in the non-developed world, and so it's an upside-down world. This will affect economies for a long time because the nations that are indebted, the developed nations, will have to implement austerity measures for a long time. Over the weekend, the UK, the Treasurer, Osborne, talked about how even if in a recession, they would continue with austerity measures because they recognize that in a recession, they'd be targeted by investors.
It's like you wrote the script for me, Tony. I mean, here's debt to the moon. We're bringing up a chart, Tony, of debt. 1960, too much information. 1960 out to 2010. It's like a Zen, too much information. Tony, how do we get our austerity on board? How do we become austere?
United States?
Yes, the United States.
In that case?
Now, I don't mean Pacific Investment Management Company. I mean the whole United States.
Of course. We were wondering which nation you were talking about. The United States, of course, it depends on entitlement spending because such a small portion, $600 billion and somewhat, of the fiscal spending is in discretionary spending. You hear often about caps in those areas and freezes of 5%, 10%, but the amount of money that can be frozen in that $600 billion category might be somewhere a small fraction of a few hundred billion, so 5–10% of a few hundred billion. It's so tiny for an economy that has a deficit, a nation has a deficit of over $1 trillion. So ultimately it comes down to very hard choices with respect to entitlements. This is an issue that the Congress kicked the can down the road on this year, and we'll have to see how it treats it next year when the election is over and there are new people in Washington.
Tony, you are the pro at the money market fund space. You are the one that can speak perhaps better to anyone that's a retiree or a saver. Bring this up.
Save for Paul McCulley.
Yeah, bring this up right now. Savers search for yield. Tony, this is a hugely distressing chart. Savers search for yield. It's a one-year CD rate down to a 0.76 level. Tony, let me cut to the chase. Are the elites and are the haves dropping the burden of this crisis on the have-nots, on the savers of America?
One could say this is a period of financial repression for savers and investors in fixed income to the extent that these rates are below the inflation rate, and investors typically would not want to achieve these sorts of rates. And part of the reason why the rates are so low in the banking system is because the savings deposit inflow is very sharp. In fact, over the past 8 weeks, we see M2, which is the broad gauge of the money supply, growing at a 9% annual rate. So those reserves we hear a lot about that the Fed has put in the system starting to convert into something, but mostly savings. People are still in a very precautionary mode because they're still deleveraging. They want to get their debts down relative to income. And this means more money in the coffers of banks, and they don't need payout high rates of interest, therefore. And, of course, it ultimately depends on what the Federal Reserve sets as the interest rate.
Tony, unfortunately, we've got to leave it there. We've got to have you back for a longer period. They're always interesting.
All right,
Tony
Tom,
Crescenzi of PIMCO coming